Good morning once again, and welcome to the Haven Financial Group radio show. Thanks for listening this morning. Feel free to give us a call at 612-504-8400 or visit us online at havenfinancialgroup.com. Send us an email, info at havenfinancialgroup.com. Ask us questions. Come on in and visit with us. We're not shy. We like to have really good coffee, and how about a cookie to go with it, just to lighten this conversation up just a little bit. So, again, talking about inflation and all the other retirement topics that are so important as we plan for retirement, or maybe you're 5 years or less before you retire, or maybe you're already in those golden years. I hope those years are golden, but we want to continue to be good stewards and make good decisions, and we can never stop learning. So education, again, so extremely important.
So let's talk about some mistakes that we can avoid and ways to avoid them, not just because inflation is a little bit higher, but mistakes in general when it comes to retirement portfolios. Let's start with overparking in cash. We talked about cash in the last segment. We said it is imperative that you have cash on hand because life changes. But what if you got too much cash, Kyle?
Well, this is one of the biggest mistakes we see with people and having too much cash. Like Larry mentioned, you want your emergency fund. You at least want that. But having too much cash can be problematic because for a couple of reasons. One, your purchasing power is at risk with this. If inflation's high and you're in cash, you're actually losing money. You're having a negative return of whatever inflation is on that money. So in 2022, that was minus 8% for people who are in cash, right? So that's one of the reasons. And then a second reason, in times of higher inflation, the stock market tends to do well. So that's an opportunity cost risk right there, where you could have been invested in the market and making money rather than technically, losing money with purchasing power. Yeah. So that is one of the biggest reasons. Yeah, go ahead.
Sure. I just was going to say the flip side of that, though, would be chasing yields, like just, constantly putting your money wherever you can, thinking this is going to yield you something, correct?
Absolutely. Yeah. We don't want to just, put our money into any kinds of bonds. And one of the most common ones that I see is high yield bonds. And when people come in with those, they show us their statements and we're reviewing all of that. High yield is a really high percentage of bonds that we see. And every time I see that, we always have a conversation about, we don't want to be taking risk within our bonds. We want our bonds to be our stability and something that doesn't have a lot of volatility. High yield bonds have a lot of volatility. They are also called junk bonds in the industry because they have a high default risk. Well, when we have higher inflation, we don't want to take any more risk than we need to in bonds because those are already, a little more risky in higher inflation, let alone high yield bonds. So it's really important to know what kind of bonds you're holding to see if it is good in times of inflation, if it's good quality bonds, and if they're low volatility types of bonds. So make sure you know what bonds you own.
Mm-hmm. Let's talk about autopilot withdrawals. Not paying any attention. You just get certain money drawn off. So you're not paying attention to what the stock market might be doing. That has to be a huge mistake. And I'm sure it's one, unfortunately, a lot of people do.
Yeah. And all of our retirees, or I should say almost all of them, are getting some kind of systematic withdrawal so they can live their life. Sure. And whether that be monthly or quarterly or semi-annually, however that is, there's withdrawals. We can be strategic about those withdrawals as well. If the market is having a good year, maybe we have raise enough cash from selling some of those stocks and investments to keep on the sidelines, so we have enough to cover for 6 months or a year of withdrawals. Or maybe if the market's having a down year, we try to keep going on a monthly basis and trying to sell from things that maybe aren't down as much, so we can try to let the things that are down recover, right? So we're choosing which areas we take from to send out the distributions and withdrawals, but we're also taking our profits to some degree, and keeping some cash on the sidelines when we've had a good year, and making sure that part is out of the market, and we have enough to live on for at least 6 months or a year.
And to both of you, I would assume that one of the biggest mistakes that anyone can make is not being cognizant of the tax ramifications from where their money is and when it's being drawn.
Yeah, I'd say tax drift, we call that, not courting taxable, pre-tax, Roth, non-qualified brokerage, drawing from the wrong accounts, causing you to creep up in the tax brackets, maybe causing an IRMA surcharge that you weren't planning on, and lower after-tax income situations. So a variety of things. And I would add to that, having the wrong types of investments in the wrong types of accounts. I think back to 07, 09, the real estate market was in the toilet. People retired. And I remember seeing a lot of retirees have REITs. Now, we're not saying REITs, real estate investment trusts, are bad, but they're an alternative investment. They're rather illiquid. And I remember folks that had those, and they couldn't even access their own money because real estate was down and they were insolvent. So they couldn't even access their money. So the wrong types of monies and the wrong types of accounts in the wrong stage of life. You want to get that right. You don't want to be forced into a corner. So making these good decisions. And again, how do you do that? Well, you can research and research and research, or have a partner that you can come on in and lean on, ask as many questions. I get a kick out of folks say, man, I've had a question for 15 years. Well, why not get the answer to the question? Well, I don't know who to ask. Well, are you working with anybody? Yeah, but no, there's no but. Just get the answers to your questions.
Yeah, absolutely. Well, we've been talking about inflation and how it impacts retirees. And I think this has been a really informative show. I want to ask Kyle what he hopes the takeaway is for people who are listening today when it comes to inflation and a retiree's portfolio.
I think the biggest takeaway is, are you having a conversation revolving around your sustainability and inflation? That is one of the biggest things, because most likely, if you're retired or close to retirement, where you're at with your investments, and if those investments themselves, are going to be good for retirement, or maybe you want to have a check on that. But one of the biggest derailments can be inflation. And it's important to make sure that you're working with a partner who incorporates that and is planning for that and has strategies around that and whatever different inflation numbers that we see in the future.
Mm-hmm. Larry, how about you?
Well, it comes back to the big picture. Do you have all the retirement puzzle pieces? From estate planning, we have that in-house. Our estate planning attorneys, Carrie and Keith, do you have an estate plan? Have you reviewed any long-term viable options for nursing home, long-term care? I know we don't want to talk about it, but it is a major expense potentially. Life insurance review. When's the last time you did that? It's open enrollment, as I mentioned. Come on in and visit with Glenn or Isabella and make sure you're going to be in the right plan with all the changes going on with these healthcare providers. Again, whether you're on the open market for Medicare, MNsure, your investment, stress test that portfolio. It's fourth quarter. You should be having these tax discussions. Come on and visit with Lance, our CPA, or Melissa. And is a Roth conversion the right thing to do? Are you going to fill that 12% bracket up, or are you just not going to have the conversations that you should be having because nobody's on your side and you're not working with anybody, or you're simply not getting the attention that you're paying for? So why aren't you getting the attention?
All right. So why aren't you getting the attention, folks? If you're listening and you need that kind of attention, if you're looking for a partner, give the folks at Haven Financial Group a call. 612-504-8400. Give them a call today. Tell them that you heard us here on the radio. You'd like to come in, sit down, talk to them about whether you are in those golden years, and hopefully, as Larry said, they are golden, but if they are not, or you're concerned, go in and have your portfolio stress tested, and sit down and maybe have it reviewed. Or if you're thinking about those years, you realize now is the time to start to put together a plan. They can help you at Haven Financial Group. 612-504-8400. Gentlemen, thank you so much. It's been great, like always.
Great to be with you, Kim. Have a blessed week.